The screen is dark. A single number flashes. 100, that's what a $100 bought in 1990. Now, it buys barely half. You blink. You check your bank app. It still says 100. But your money, the very thing you trust, has quietly lost value year after year. And almost no one talks about it this way. Here's the truth. Every morning, millions of dollars are printed, lent, spent, or erased. And each transaction chips away at the value of your dollars. It's subtle, almost invisible. And that subtlety is what makes it dangerous. By the time most people notice, they're already behind. Why should this matter to you? Because this isn't some abstract statistic. It's in your grocery bills, your rent, the price of gas, even the interest on your credit card. Your paycheck might go up, but the numbers on your bank statement are not the numbers that matter. What matters is what those numbers can actually buy. And that purchasing power, it's shrinking. Let's break it down. Start with inflation, the most familiar culprit. You've heard the term. You know the idea. Prices go up. But what if I told you that the official inflation number, the one reported every month, often understates what you feel at the checkout line? That the real rate at which your money loses value is usually faster than the headlines suggest. Here's a simple example. Imagine a loaf of bread cost $2 10 years ago. Today it costs $3. That's a 50% increase. Your $100 could buy 50 loaves back then. Now it buys 33. Your money hasn't grown. It's shrunk. And that's just bread. Gas, healthcare, tuition, all rising faster than wages for many people. But inflation doesn't appear from nowhere. It's engineered in part by the mechanisms of modern finance. Central banks, governments, commercial banks, they all play a role. Money is not a fixed thing. It can be created. When more money floods the system, each existing dollar buys a little less. That's how your savings slowly lose value, even if you don't spend them. And here, that's the irony. The system is designed to encourage spending and borrowing, not hoarding. Holding cash feels safe, but in reality, it's a slow leak. Every dollar you tuck under a mattress, every secure checking account, is quietly depreciating in purchasing power. It's a system that rewards movement over stillness. There's also a hidden dynamic that rarely gets discussed, compounding. Not just interest, but the compounding effect of money creation and debt cycles. Each new loan issued, each government bond sold adds layers of pressure that subtly push prices up. It's like climbing a hill that keeps growing taller as you ascend. You're running just to stay in the same place. And yet, this system is wrapped in reassuring words. Economic growth, quantitative easing, low inflation targets. The language makes it feel controlled, logical, even benevolent. But the lived reality for most people is the opposite. Dollars that seem stable on paper are eroding in your pocket. Now let's peel back another layer. Beyond inflation, there's a hidden architecture quietly deciding how much your money is worth. Banks. Not just the ones you walk into, but the entire banking network. They don't just hold money. They create it. Every time a bank issues a loan, new money appears. It's not borrowed from someone else. It's invented. Digital keystrokes, nothing more. And with every keystroke, your existing dollars lose a fraction of their value. Consider this. If one bank lends $1 million, those aren't dollars taken from someone else's account. They are new dollars. Suddenly, there's more money chasing the same goods. Prices rise. Your $100 now buys slightly less than it did yesterday. Repeat this process across thousands of banks, millions of loans, and over decades, and the erosion compounds. That $100 you trusted so much slowly slides downhill, almost imperceptibly. Here's where it gets stranger. Governments, too, are involved. They borrow, they spend, they run deficits. To finance this, they issue bonds. And central banks often buy those bonds, effectively printing money to fund spending. It's not always publicized as printing. But that's what it is, and the public rarely feels the mechanics until prices rise. By then, the damage is baked into your everyday life, and there's an incentive structure most people don't see. Banks profit when people borrow and spend. Governments benefit when debt circulates rather than stagnates. Savers? Not so much. Holding cash looks safe, but in this ecosystem, it's a quiet trap. Ironically, the system rewards the very behavior that reduces your money's value: borrowing, spending, and keeping pace with rising prices. Now let's talk numbers. Average annual inflation over the last 20 years has been roughly 2 to 3% officially, but real-world prices for essentials often rise faster, sometimes 5%, 6%, or more. Compound that over 20 years. A dollar today might be worth only half of its value compared to 2 decades ago. That's not theory, it's arithmetic. The formula is simple. A future value equal to present value, so a 1 plus inflation rate. Years. A subtle, quiet decay, invisible in daily life but relentless in the long run. Even more unsettling is how this interacts with interest rates. Savings accounts often offer returns below inflation. So while your bank statement shows growth, your purchasing power is shrinking. A $100 gain in your account might still leave you $2 or $3 poorer in real terms. The math doesn't lie. The system does. There's another twist: wealth concentration. People with assets, property, stocks, businesses can often outpace inflation, but cash holders, the everyday middle-class saver, cannot. The mechanisms that create money often favor those already embedded in financial networks, widening the gap between those who gain and those who quietly lose. And yet the narrative is reassuring. Central banks and policymakers assure us that inflation is under control, that the economy is stable, that prices will normalize. But what they don't often say is that the system is engineered to prioritize liquidity, circulation, and growth, not the preservation of everyday purchasing power. The message is comforting. The reality is slowly corrosive. Let's take a closer look at the incentives embedded in the system. On the surface, the economy appears orderly. Central banks announce rates. Governments report budgets, and financial news reassures the public. But behind the scenes, the system operates like a carefully tuned machine, one that silently favors movement over stability, debt over savings, and those already connected over those who aren't. Consider this: every time a government issues new debt, it's borrowing from future taxpayers. The borrowed money stimulates spending now, inflates markets, and creates the illusion of prosperity. But the cost is deferred and hidden in everyday price increases. That $100 in your pocket is silently contributing to a system that slowly dilutes its value. You are both participant and victim. Here's the uncomfortable math most people never see. The total global debt today exceeds $300 trillion. That's trillions with a T, and it's growing faster than the global economy. When debt outpaces economic growth, money loses its relative value. Prices rise to adjust, wages lag, and the real purchasing power of ordinary savings declines. This is not speculation. It's arithmetic. Your dollars are being redistributed through a complex system of incentives, loans and repayments that few understand but everyone experiences. Now think about what the media tells you. Markets are stable. Consumer prices are under control. The economy is growing. These statements are true in a narrow sense. Stock indices might rise. Unemployment might fall. But those headlines often mask a deeper reality. The average consumer is paying more for essentials while their money buys less. The public perception of stability contrasts sharply with the underlying erosion of purchasing power. It's an invisible tax, ongoing and relentless, but rarely labeled as such. And it's subtle, almost absurd, how this plays out in daily life. You might get a raise of 3%, while the cost of groceries climbs 5%. That 2% difference compounds year after year. 10 years in, a modest $100,000 salary has lost tens of thousands of dollars in real purchasing power. You're earning the same nominal number, Yet, your ability to live the same lifestyle has quietly slipped away. This is the silent irony of modern money. There's also a psychological element. People assume money in their accounts is safe. It's tangible, immediate, reassuring. And yet, in this system, safety is a form of invisibility. The more cautious you are with cash, the more slowly it erodes, but it erodes nonetheless. Spending, investing, borrowing, these are the behaviors the system rewards, not accumulation. The rules are logical once you understand them, but they invert the intuitive assumptions most people carry about money, and it's global. Inflation doesn't stop at borders. Currency depreciation, debt cycles, and money creation ripple across the world. A rise in commodity prices in one country affects groceries in another. Exchange rates shift, trade balances adjust, and your local purchasing power fluctuates with decisions made by entities you will never meet. The world economy is a network, and your dollars are quietly caught in its current, slowly weakening as the tides shift. Now let's widen the lens. This erosion of value isn't just a personal problem, it's systemic. Every dollar slowly losing its power is a signal of the broader forces shaping our global economy. Countries with massive debts, central banks printing trillions, and financial networks that prioritize liquidity over preservation. These aren't distant headlines. They are the engines behind the slow, persistent shrinking of money's real value. Look at history. Hyperinflation in Weimar Germany, collapse of Zimbabwe's currency. Even moderate, sustained inflation can silently reshape society. Savings evaporate, trust in money declines, and social systems strain under the weight of financial instability. Today, the same mechanisms exist, just more subtly, more quietly, and globally interconnected. The danger isn't always sudden, it's incremental. By the time panic sets in, the effects have already reshaped lives. There's another layer most people miss: inequality. Those who hold assets, stocks, real estate, commodities, are often insulated from the erosion of cash. Their wealth grows faster than inflation. Meanwhile, those who rely on wages or savings accounts see their real purchasing power diminish. The system doesn't just erode money, it reshapes who can maintain financial stability. It amplifies advantages for those already inside the networks and compound challenges for everyone else. And here's the irony: the very mechanism designed to stabilize the economy, monetary policy, interest rate management, bond purchases, can sometimes accelerate the erosion. Lower interest rates encourage borrowing and spending, but they also reduce returns on savings. Quantitative easing injects liquidity, supporting markets, but each wave of new money subtly devalues what you already have. The system is calm on the surface, yet quietly corrosive underneath. Now, consider the psychological toll. Most people never calculate how much real purchasing power they've lost over a decade or more. Money feels static. It looks the same, but in reality it is a river slowly receding beneath your feet. And that visibility, what makes it so effective. It doesn't announce itself with fanfare. It doesn't demand attention. It just keeps working quietly against you. So what does this mean for the average person? Awareness is the first step. Understanding that your dollars are not fixed, that value is relative and eroding, reframes financial decisions. But more than that, it invites a broader question about the systems we trust, about central banks, governments, and financial institutions. If the value of money is subject to slow, systemic erosion, then the real question isn't how much you earn, but how well you understand the hidden currents shaping your wealth and the unsettling truth. The system isn't going to stop. The forces at play are global, deeply embedded and self-reinforcing. Your money will continue to lose value over time, quietly, predictably, inexorably. What you do with that knowledge is up to you. But remember this: the numbers on your bank statement are not reality. They are just a reflection of a system designed to move, shift, and evolve, whether you notice it or not, in the end. The question remains: if money is never truly safe and its value is always slipping, then what does wealth even mean?